Thank you for joining Market Insights. I'm Jack Thurman, president of BKD Wealth Advisors. A perception of a struggling U.S. economy has continued to push the U.S. markets lower in recent months. But are these conditions really to blame? Today I've asked Jeff Lehman, our Chief Investment Officer, to address some of the common questions we are receiving in regards to our current economy and market environment. Jeff, the markets have been really volatile over the last several months. Is there really something basically wrong with the economy right now?
Well, we think that really what's going on right now, Jack, is a crisis in confidence. If you look at the surveys of both businesses and consumers, they just don't feel very good about our economy right now, and that's reflected in the marketplace.
So there's a pessimism. Is that pessimism justified?
Well, I think it's important to distinguish between what's known as the soft economic data and the hard data. These consumer sentiment and business sentiment readings are one version of the soft data. They reflect how people and businesses feel about the current state of things. Those feelings have really been influenced lately by primarily the debt issues in Europe and the U.S., and also the way the legislators have handled those issues, and therefore the sentiment readings have really deteriorated in recent months. But if you look at the actual hard economic data, these are the statistics that indicate how the economy is currently doing. They paint a bit of a different picture. They're actually improving in recent months. Some of the examples that support that are that GDP, or the growth in our overall economy, actually grew by 2.5% in the third quarter, almost double what the gain in the second quarter was. In addition, S&P 500 companies that have reported earnings, 3/4 of those have exceeded estimates again in the third quarter. And then finally, retail sales, despite the fact that the consumer sentiment readings have been really poor, were up the most since April in the month of September, and that was largely driven by auto sales, which is a big ticket item. So things in the overall economy are actually going pretty well.
So Jeff, if the economy is growing, why are stocks still volatile?
Well, the first thing is that this crisis in confidence has the potential to become a self-fulfilling prophecy. If business owners and consumers don't feel good about the economic outlook, that may cause them to actually rein in purchases or other economic activity, and it could create further weakness in the economy and reverse some of the progress we've made in recent months. So that's one issue. The second issue is that investors are conditioned to think the worst anytime we run into a challenge in the markets, and are pretty quick to sell stocks, quite frankly, in this environment. So when you've got an economy that's recovering from the sort of downturn that we had, deep downturn in 2008 and 2009, there are natural fits and starts that happen along the way, but investors are having a little more of a challenge sticking with their long-term investment strategy at times when you have this sort of volatility.
Jeff, you've talked about hard data and soft data. What should investors be focused on when making investment decisions?
Well, in our view, Jack, without question, paying attention to the hard data is really the most important thing for good investment decision making. And the reason is the sentiment, or the soft data, if you will, can change course very rapidly, and it's also a lagging indicator. So in other words, what it tells you is what people feel about things that have already happened. The challenge is that the stock market is a leading indicator. So it's trading today based on what it expects to happen tomorrow and in the future. So the catch here is that by the time people start feeling better based on the lagging measures about the economy or the markets, chances are the stock prices are already at higher levels, so they've missed an opportunity there. You know, there's a saying that the best time to invest is when it feels the worst. And we may be in one of those moments because the underlying corporate and economic fundamental data indicates that stocks are the best values that we've seen since early 2009.
That's encouraging, Jeff. Thank you very much. As market and economic events occur which impact our clients and raise common questions, we'll continue to provide these educational broadcasts. For more information about BKD Wealth Advisors, please visit our website at bkdwa.com. Thank you for joining us today.